Imagine buying a stock before it skyrockets 200%. Sounds like a dream, right? But here's the reality. Not every IPO is a jackpot. In 2024, some stocks turned early investors into overnight winners, while others crashed hard. So how do you spot the real gems? How do you know if an IPO is worth your money? Is it all about hype, or are there clear signs to watch out for? We'll break it down for you in a simple and practical way. Ever wondered how companies go from being private to publicly traded? Now that's where IPOs come in. An initial public offering, or an IPO, is when a company decides to sell its shares to the public for the first time. So how do you know which IPOs can have real potential? Now for instance, take Nykaa. It entered a booming beauty e-commerce market, had strong brand recognition, and built a loyal customer base, making its IPO a success. On the other hand, Paytm faced stiff competition and struggled with profitability, which led to a rocky market performance. Now, would you trust a company with your money if it can't even manage its own? Before investing, check if it is built for long-term success or just running on borrowed time. Here is what to look at before putting your money in. Revenue growth. A company that consistently makes more money is a good sign. If sales are flat or declining, that's a warning sign. Second is profitability. Making money is one thing, keeping it is another. So if a company keeps losing cash with no clear path to turn things around, it's a risky bet. Third is debt levels. Too much debt can strangle a company's growth. A business buried under loans will struggle to invest in the future. The draft red hearing prospectus, or DRHP, is like a company's blueprint before it hits the stock market. Think of it as behind-the-scenes look at its business model, financial health, risk, and most importantly, how it plans to use your money. Now here are the key things to look for in the DRHP. Number one is funds used for growth and expansion are a good sign. Using them to repay debt or let early investors exit can be a concern. Second, look for challenges like competition, legal issues, or market risk. Number third is if company leaders keep their shares, they trust the future. Selling a big portion might signal doubts about their long-term success. Number fourth is a company with steady earnings and growth plans is more stable. Constant losses with no clear profit path make it a risky bet. Number five, a strong industry presence and competitive advantage help a company succeed. Weak positioning in a crowded market can be a red flag. How similar IPOs performed? Well, past IPOs in the same industry can offer valuable insights. Here is what you should think about. Number one, stock market trends. When the market is bullish, IPOs usually ride the wave. If things are shaky, even strong companies might struggle. Number two is gray market premium, or GMP. Think of this as the IPO's early buzz. A high GMP means strong demand before listing, but don't rely on it blindly. It's not a guarantee. Number three is anchor investors. Big players like mutual funds and foreign investors jumping early in an IPO can be a green flag. If they are backing the IPO, they see potential. So before applying for an IPO, go through this quick checklist. Is the company in a strong and growing industry? Are the financials strong and profitable? What is the company using the IPO money for? How does it compare with competitors? What's the market sentiment like? If most of these answers are positive, the IPO could be a good investment. Have you ever invested in an IPO? How did it go? Big win or lesson learned? Share your experience in the comments. If you found this helpful, hit like and share it with fellow investors, and subscribe for more smart investing tips.